Well, good morning, and it's nice and sunny weather behind me, and outside in Melbourne it's a little bit cooler, but nevertheless, let me get right into today, which is based upon a lender's update, a retail lender who has just given us, as brokers, we get these regular updates and information sessions, and these particular lender has some niches that they wanted to talk about, and I thought they might be useful for you out there in case some of these circumstances might fit. So I'm just going to run through some of them quickly. First one is for owner-occupied dwellings, a 95% LVR, loan-to-value ratio, inclusive of LMI, which stands for Lender's Mortgage Insurance. Now, there are a few lenders out there offering 95% for owner-occupiers, but this particular lender is keen to look at deals in that space, and they would include construction loans. They'll also go to 90% LVR, including LMI for investment property purchases. So that's they're at the upper level. There are a few other lenders who will also be in that space, but at least a reminder that if you need a level of borrowing that's at the high amount, you can still get the property you're after, as long as you obviously meet servicing, debt to income ratios and things of that nature. They then probably become a little bit more important. They'll also give cash out up to 80% LVR with a stated purpose. So this, in that particular case, if it's more than $100,000 you want out, if it's a purchase of another property, then they'll need a pre-approval for that property. If it's for renovations, they'll need to see quotes, etc., and things of that nature. They'll also do refinance of business debt up to 80% LVR at residential rates. So if you've got a owner-occupied property, but you've also self-employed and got some business debts, you can get them funded at residential rates. That can be quite an advantage for some business owners, where they otherwise might be paying quite high rates to lenders who are lending on a commercial basis. They can also consider paid defaults on a case-by-case basis, typically less than $2,000 a default. And you can also purchase vacant land with the owner-occupier intention up to 95% LVR in the Melbourne metropolitan area. You'll probably also need to have your broker prepare for you servicing calculations for construction as well, which obviously we can do. They do bridging loans, relocation loans, so where you're selling and then repurchasing. You might find that there's a time where you can't sell your existing property, and they'll provide bridging finance, and they'll base the bridging finance on the servicing on the end debt, so after you've sold your property. They also like to play in the medical and accounting and legal space, where they offer 90% with no LMI, so 90% LVR with no LMI. So this might be of relevance to you. And they've got some niche areas in the medical, dentists, vets, and pharmacists. The next one they mentioned was family pledge, which is where a member of the family, in their case, they include parents and siblings, for an owner who have an owner-occupied property, and they'll lend to 100% plus reasonable costs, and no servicing calculation required for the member of the family who's providing the pledge. So it's just going to be based upon your servicing and your ability to service that loan. So that's quite good. It's quite a high level, and compared to, and I'm going to compare this quickly to the current scheme available that was introduced as part of COVID, which is the home loan deposit scheme. That goes up to 95%, so you've still got to provide 5%. In this case, with the family pledge, you don't need to provide any deposit, which could be quite useful for some people who haven't got the money for a deposit, and they've got family or siblings who have equity in their owner-occupied premises. And the last one was what they call the common debt reducer. So let's say you've got a property that you've purchased with a brother or sister, and you're looking at borrowing money to buy your own property, they will only take into account 50% of the debt and 50% of the rental income for you, as opposed to 100% of the debt and 100% of the rental income, which can sometimes make a deal too difficult to get through. The only thing they need to see is that you're co-owner of the existing property that you've purchased, that they can service the remainder of the debt that's allocated to them. So in this particular case, it'd be the remaining 50%. Okay, so that's the end of that. Hope that's of interest to you. I hope there's some tidbits there that you might be able to take away. And I'm going to go and have a swim. Catch you later. Cheers.